Next, we turn to amortization expense. Amortization is the allocation of the cost of intangible assets over the number of years that these assets are expected to help generate revenue for the company. And this is conceptually almost identical to depreciation, and it's often lumped in with depreciation, and it's called depreciation and amortization, or D&A, in financial disclosures. You'll often, instead of having one line for depreciation expense on the cash flow statement, another line item for amortization expense on the cash flow statement, you'll actually see one line item called depreciation and amortization, because they're really identical. The only difference is amortization represents depreciation for intangible assets, whereas depreciation is for fixed assets. And like with fixed assets, when a company purchases an intangible asset from which it expects to generate benefits over future periods, the cost of the asset is not simply recognized during the year that it was purchased, but rather it's spread over that particular asset's useful life in the form of amortization expense. Now, let's talk about the types of intangible assets that exist. The most common types of intangible assets that companies have are when they buy customer lists, when they acquire franchise rights or memberships, licenses to certain things, when they purchase or acquire patents and technologies, and last but not least, trademarks. If they buy a trademark or a brand name from another business, that certainly has value. And so that's an intangible asset. And lastly, there's a unique kind of intangible asset that I'll talk about in a moment. We'll just defer a discussion of what goodwill is really about. But goodwill is a specific type of intangible asset as well. We'll talk about that in a little bit. But what makes goodwill and most trademarks unique is that they're considered to have indefinite useful life. So a trademark is supposed to have an indefinite useful life. So unlike some of the other assets like customer lists and patents that have discrete expiration periods, trademark and goodwill is like land for fixed assets. It's considered to have an indefinite useful life, and so it's not amortized. So amortization expense you're not going to see associated with goodwill or trademarks. So let's go through a simple example of a intangible asset amortization scenario. And so let's say Google invests $30 million to acquire several patents from a mobile technology firm. We know that they did something like that with Motorola. The patents are expected to have a useful life of 10 years. Accordingly, on the income statement, Google will recognize an annual amortization expense of $3 million every year for the next 10 years. Just like with the GE example, it doesn't matter that Google spent $30 million up front. What's being recognized under accrual accounting is that $3 million expense every year over the 10-year useful life of the intangible asset. And in fact, let's look at Google's 10K disclosures, and we can see exactly what's going on when it comes to these intangible assets. We see that the company has about $6 billion in recognized value for intangible assets. And let's see what they say about it. Patents, and this is in their footnote. This is in their footnote after their financial statements. Patents and developed technology, customer relationships, trade names, and other intangible assets have useful lives that range anywhere from 8 years to 5 years. And the amortization expense of these intangible assets in 2013 was $1.158 billion. So they recognized $1 billion in amortization expense in 2013. The fact they bought it in the past, but they're recognizing amortization over these useful lives for these individual intangible assets. And they've also provided disclosure. In fact, US GAAP requires a disclosure for intangible assets of what the expected amortization expense is going to be for already purchased intangible assets over the next 5 years. And we see that all these assets that they've bought, they have future amortization expenses as follows. $1 billion next year, very similar to $1 billion this year, and on it goes. And then beyond 2018, they just have a thereafter line. That after 2018, they have $1.6 billion in expected amortization expense, which is 2019 and beyond. And and that makes sense that it's not a lot more, because we see that the useful lives here are only 5 years, 6 years, or 8 years. And so if they're beyond the 5-year period, they've fully amortized through most of their intangible assets. Just like depreciation, amortization is a non-cash expense. Again, the only difference between the two is that depreciation refers to fixed assets, while amortization refers to intangible assets. One caveat here that's very important and often misunderstood when it comes to intangible assets is that expenses associated with internally developed intangible assets, things like patents, customer lists, trademarks, these are expensed fully as they're incurred. So when you're internally developing something like a patent, since companies aren't allowed to write up the value of intangible assets, this is the historical cost principle and conservatism principle. Companies with very valuable trademarks and patents, think about like Coke, GE, Apple, consumer products companies like Procter & Gamble, they don't recognize or amortize these assets. So what you see on company balance sheets in terms of intangible assets is really the value of acquired intangibles. Internally generated intangible assets, really like the brand name of Coke, is not going to be recognized in the balance sheet. So make sure you understand that there's a real difference between intangibles that you acquire. That's what you recognize value for and amortize. But things that are internally generated, really the only thing that FASB or US GAAP lets you recognize is, the legal costs, the filing fees of filing a patent and things like that. These are negligible costs, and you recognize them as they're incurred. You're not even amortizing them because they're considered one-time fees. The fact that the value of these assets grow over time cannot be recognized in the balance sheet because of historical costs and conservatism. So let's go through an exercise. Hit the pause button and go through this exercise to make sure that you fully understand amortization expense. When you're ready, let's move on. So for each item below, you were asked to identify whether it should be amortized, depreciated, fully expensed, or none of the above, as well as whether the expense belongs in cost of goods sold or other operating expenses, something other than cost of goods sold like SG&A or what have you. This was actually somewhat of a challenging exercise. So let's go through all of these one by one. The cost of building an automotive factory is certainly going to generate depreciation expense. An automotive factory certainly is going to have a useful life of more than 1 year. So that's depreciation. And because the automotive factory is tied with the direct production of the automobiles, that depreciation expense is going to be recognized or bundled into cost of goods sold expense on the income statement. Next, we talk about cost of building an office to house marketing, administrative, and management staff for an automotive firm. For the same automotive firm, you now have another building that they're building, except it's going to be for a different use. So you're still going to have depreciation expense, but unlike the factory, these administrative offices are going to be recognized as SG&A. And so you're going to see that, or we call it other operating expenses here, more of a catch-all category. So that's where that depreciation is going to go. So understand that depreciation goes by the nature of the depreciation is allocated depending on what the function of the assets that are being depreciated are. Next, we turn to cost of salaries for assembly labor in an automotive firm. So salaries are not depreciated. These are annual salaries. The benefit is just for that year. And so that's going to be fully expensed during the period. And of course, since it's tied to direct manufacture of the car, that's going to be cost of goods sold. Next, cost of acquiring a customer list by the automotive firm is going to be amortized. A customer list is an intangible asset. And that, of course, is not tied to the direct manufacturer of the car. That's going to be other operating expenses. Next, cost of patent filing fees for a new windshield wiper technology that's internally developed. So the trick here was to understand that it was internally developed. The cost of the filing fees are just expensed immediately as they're incurred. And that goes into other operating expenses. If the company had an R&D expense line, or had we allowed for you guys to identify an R&D line, that's probably where that would have gone. But since we just have a catch-all, all other operating expenses, that's where these patent fees would go. Lastly, the cost of acquiring a trademark, as opposed to developing one internally. The cost of acquiring a trademark, this is really an interesting point. Since most trademarks, are ascribed indefinite useful lives, they're never going to cycle out through the income statement. You're not going to recognize amortization. You're not even going to expense it. It's just actually going to sit on the balance sheet as this valuable thing that you have, but it never declines in value, just like land, which just sits on your balance sheet at the value that you bought it at.